The Federal Reserve just shocked the market by raising interest rates by 75 basis points, triggering yet another chain reaction that will affect the entire market. At their core, interest rate changes have a significant knock-on effect on everything from housing stock values to cryptocurrency holdings to saving accounts, auto loans, and credit cards. This is the beginning of a trend that many newer investors have not seen before, and it is critical to understand what to expect. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. We must discuss what the Federal Reserve is. The Federal Reserve is a central bank, whose role it is to supervise our economy, regulate financial institutions, and control the flow of money into and out of the system. Their top priority is to ensure that we have a strong labor market, that we maintain maximum levels of employment, and that they can regulate the financial markets in a way that keeps us away from record-high inflation. They're now attempting to prevent a full-fledged recession by raising interest rates and crashing the market. The federal funds rate is the starting point for all of this. This is the interest rate that banks can charge each other when they lend money to each other. The federal funds rate, on the other hand, serves as a guideline for how much interest banks can charge other banks. Consider this. When the federal funds rate rises, financial institutions must pay more money, which is then passed on to you, the customer. The goal is that by doing so, consumer demand will begin to shrink, growth will slow, and inflation will eventually return to its 2% target. In the short term, they want to achieve what is known as the neutral interest rate, which is an interest rate that neither stimulates nor inhibits growth. To make matters even more complicated, the neutral interest rate is unknown. It is only estimated based on various analysis and observation. It's now assumed to be somewhere between 2.5% and 2.7%, which means we could get there by the end of the year. Others argue that this assumes that inflation will fall, and that if it does not, they may need to raise rates even further, with one analysis predicting that rates will reach 4.25%. So, in terms of where we are now and how this affects your investments, here's what they had to say, as well as their warning for what's to come. As of today, the Fed raised their benchmark interest rates by another 75 basis points as they continue on their path to bring the highest inflation in 40 years. The Federal Reserve Board of Governors is scheduled to meet 4 more times this year, in July, September, November, and December. This means that more 75 basis point rate hikes are possible, bringing us to 3.5% to 4% federal funds rate by the end of the year. That would put us at a level not seen since early 2008, when the United States entered the Great Recession. First, whether you believe it or not, they believe inflation has already peaked and that prices will begin to fall throughout 2023 and 2024, eventually returning to their baseline of 2%. Second, they forecasted a slowing economy over the next 2 years, with the unemployment rate beginning to rise slightly. Third, by lowering demand, we increase our chances of entering a recession. On the surface, their goal is to raise interest rates enough to slow the economy and allow supply to catch up with demand. Retail sales have been reported to fall as energy prices rise, so it's reasonable to expect people to start cutting back. Fourth, today's 75 basis point rate hike was clearly out of the ordinary, and I do not expect moves of this magnitude to be common, which the market appreciated. However, a 75 basis point rate hike a month ago was not considered proof that anything could happen and that everything should be taken lightly. In May, the stock market did not begin to fall until the day after everything began to fall quickly. So, here's what you need to know about how this affects everything from stocks to real estate to cryptocurrency and the risk of stagflation. Let's talk about stocks. On the surface, investors are warning that the economy is slowing, that businesses are cutting back, that people are spending less, and that your portfolio will suffer as a result. It is true that rising interest rates make borrowing money significantly more expensive, with the Federal Reserve actively removing money from the system through a process known as balance sheet runoff. Companies will find it more difficult to perform as well, as they have in the last 2 years. Studied market behavior throughout every single rate hike since the 1960s, and they discovered that the S&P 500 gained in 80% of the previous 13 periods as interest rates rose. The average increase in the index was 6.4%, which was only slightly lower than the historical average of 7.1%. Of course, they acknowledge that rising rates during periods of high inflation have resulted in lower stock returns, with the average annual return being negative 0.4% in 5 of those rising rate periods. Of course, there is the possibility of a recession, which has resulted in an average gain of 1.3% since World War II. Surprisingly, the world market indicator is simply a bear market. When you combine that with a recession, bear markets perform even worse with an average drop of 34.8%, and for comparison, the S&P 500 is currently down about 20%. Stocks can do well when interest rates rise, but the absolute bottom usually occurs when investors completely capitulate. This means that when people stop investing, they start selling off everything they own because they believe the entire world is doomed. This generally signals the bottom and at the beginning of the recovery. The following topic will be real estate. Following the announcements of higher inflation, mortgage rates immediately rose by 30 basis points to nearly 6%, compared to 2.8% in November. Mortgage applications are down as a result of higher interest rates, and home affordability is down by 29% from a year ago. All of this means that housing prices have reached a point where fewer buyers can qualify, and because there is slightly less demand, more inventory accumulates, slowing home price growth. Parts of the country are seeing an increase in inventory compared to a year ago, with places like California seeing a 15% to 20% increase in new listings and buildings on the rise, with new construction seeing the largest surge since the Fed attempted to raise rates back in 2018. Home prices, on the other hand, are becoming slightly more difficult to forecast. This is because housing is a lagging indicator, and the data we have today is frequently the result of purchases made months ago before mortgage rates rose. Bank of America economists, on the other hand, predict that low supply will drive prices up another 15% this year, and the consensus appears to be that if prices don't fall, they'll rise by slightly less. Home price growth has been completely out of step with reality, and I believe it is a good sign that things are beginning to settle down. Objectively, there are a few facts to remember. Because real estate is so localized, not all markets will behave the same, and rents will generally remain fairly consistent even if the housing market falls. Throughout the last few days, cryptocurrency liquidity and the entire market have plummeted due to fears and continued rate hikes to offer better alternatives to investing in a risky asset. Unfortunately, what began as an uncorrelated asset is now closely following the trend of big tech, rising and falling in tandem with the stock market. As a result, Cointelegraph discovered that the market is retaining an average unrealized loss of nearly 20%. That means that, like stocks, most investors are losing money on their cryptocurrency investments. Of course, not everything is bad, and one report predicts that Bitcoin adoption will reach 10% by 2030, while newer network-based technologies are being adopted much faster than the market anticipates. Another investment manager believes that Bitcoin will eventually reach the half of the market cap of gold, or $250,000, but that this will take many years. According to him, the SEC will not approve a Bitcoin ETF until they gain authority over underlying cryptocurrency exchanges, which must happen through legislation. Whatever you invest in, be cautious and plan ahead of time in case it does the opposite of what you expect it to do. It remains to be seen whether the pain is over, and it could very well get worse. However, for the time being, the Fed is attempting to achieve a non-negative real interest rate. For example, if interest rates are 5% and inflation is 7%, the market is still 2% negative, and as you can see, 2020 completely blew the market out of any semblance of normalcy. Lenders were effectively issuing money at a negative 7% interest rate, and they are quickly working to reduce that to as close to zero as possible. In terms of practical solutions, do your best to pay down any variable interest rate debt and always get a fixed interest rate so that your payment stays the same. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.